What's up guys? So today I want to talk about a company called Snowflake, and they are going public under ticker symbol SNOW. Now the company is creating quite a stir in the media because arguably they're one of the fastest growing companies we've seen in the last decade. They're also in the business as providing software as a service, and unless you've been living under a rock for the last few years, you'll know that that's all the rage at the moment because it's absolutely disrupting traditional software businesses. And to add further weight to the hype train, we also have Berkshire Hathaway and Salesforce investing in this company pre-IPO. In this video I'm going to talk about who Snowflake are and what they do. I'm going to discuss the details of the IPO. I'm going to discuss the opportunity that lies ahead for this company. But most importantly, I'm going to spend time talking about the company's financials so that you can get a better understanding of what's under the hood of this company before you consider investing. I'm also going to show you my forecast for Snowflake's financials so that you get a better understanding around the valuation of this company. In the end guys, I want to bring you a balanced opinion and give you the information you need to make an informed decision as to whether this is an investment for you or not. I'm also going to tell you to smash that like button and hit that subscribe button. And finally, I'm going to give you my opinion on this company and I'm going to tell you whether or not I'm going to be buying as part of this IPO. So let's crack straight into it. So Snowflake was actually founded in 2012, just 8 years ago, by 3 data management experts. And ultimately they wanted to build a system that overcame lots of the limitations that they perceived with the existing systems. And what they came up with was a warehouse-based cloud platform. Now guys, if you're like me, when you first heard of a warehouse platform, you're probably thinking that it's some sort of platform for managing warehouses. Well, it's not. In fact, it's actually called a warehouse platform, because unlike a traditional database that's used for simply storing and retrieving data, a warehouse platform is specifically designed to store and retrieve data, but also to do complex data analytics. So in effect, it makes your data much more valuable at making real business decisions and having a real impact on the business. And you can imagine in today's age where everything is data, that this service is absolutely vital for businesses to understand their business, to understand seasonality, to understand trends, to understand their financials, to understand everything, especially when you're dealing with a global organization that might have 20 or 30 sites across the globe. Snowflake provides an interconnectedness across all sites at a corporate level and at a site level so that management can make key strategic decisions. Now the platform has evolved since its inception in 2012 and since its first customer in 2014, and now it includes an array of different services such as data engineering, data lake, data warehousing, data science, data applications and data exchange. And as you can see from this visual here, Snowflake's platform is built on top of the 3 biggest public cloud infrastructures, which are Google Cloud, Amazon's AWS and Microsoft's Azure. And while Google, Amazon and Microsoft all offer similar services to Snowflake, if you take out some of their services, you are stuck using their public cloud, where Snowflake operates independently of any of these public cloud platforms. And that means organizations using Snowflake have a choice of which cloud they use, and it can change over time. Snowflake also differentiates itself from other service providers by not charging an upfront fee or an annual subscription model. Instead, they charge based on the capacity that you use. This means that it's much more cost effective for smaller businesses that only want to use it for smaller use cases. And as they scale, then revenue that they give to Snowflake increases over time. The platform is used globally by organizations of all sizes across a broad range of industries. And as it stands, they have over 3,000 customers, an increase of almost 100% from the same time last year. And these customers include huge names such as Square, Logitech, Sony, Adobe, Sainsbury's, DocuSign, and the list goes on. Another interesting thing to note is 56 of their customers generate revenue for Snowflake over $1 million, and that's up from just 22 last year. So clearly Snowflake are adding real value to their customers, and clearly the amount of revenue that they're generating from their customers is increasing over time because of this. A really interesting measure that measures this is Snowflake's customer net retention rate, which is at 158%. Now any value over 100% here indicates that Snowflake is being very effective at squeezing more revenue out of their customers. Now for a bit of comparison here, normally software as a service providers, their net retention rate is somewhere in the region of 115 to 130%. So 158% is a staggering number, and it really shows the value that Snowflake are providing to their customers. Now as part of the IPO, Snowflake intends to sell 28 million Class A shares for a price range of somewhere between $75 and $85. Now this will generate in the region of $2.25 billion for Snowflake's balance sheet. But overall it gives Snowflake an IPO valuation of about $22.8 billion. For a bit of context here, Snowflake are on track to do roughly $500 billion in revenue in 2020. So that gives them a valuation of 56 times revenues. Now let me tell you, that is steep, even when you compare it to other software as a service providers, which are well known for having steep valuations. But hey look, before we judge, let's take a look at the opportunity that this company has ahead of it, and then let's have a look at the financials, so we can really understand if the valuation is warranted or not. So Snowflake calculates a total addressable market of $81 billion. In their S1 filing, they say that according to IDC, the markets for analytics, data management and integration platforms, and business intelligence and analytics tools, which we believe we address, will have a combined value of $56 billion by the end of 2020 and $84 billion by the end of 2023. In order to achieve some of this addressable market, they outline some of their growth strategies, which is to advance the data cloud through the adoption of their platform. And they intend to make significant investments both domestically and internationally in sales and marketing, research and development, and our partner ecosystem to drive our growth. So here we're getting a flavour for what Snowflake intend to do with the money they generate as part of the IPO. Clearly they're eager to continue expanding, and they're going to use the proceeds to fund that expansion domestically and internationally. Now one thing that Snowflake offers that's unique to their platform is this concept of data sharing. And this is the concept that some people are saying is Snowflake's moat over other software as a service providers and other data platform providers. Essentially, Snowflake leverages its data providers, its partners and its customers to create a network effect among them. So the more customers that adopt the platform, the more data can be exchanged with other customers, partners and data providers, and essentially enhances the value of the platform for all users. Honestly, I don't know enough about this opportunity to comment on it, but from listening to people who actually know about this industry, this concept seems to be really new, and the opportunity it's going to create is currently unknown and largely untapped. In an industry that seems to be ahead of its times, that seems to be at the cutting edge of technology and innovation, Snowflake certainly seems to be at the edge of that industry. Now, Snowflake is run by Frank Slootman as CEO and Chairman Michael Scarpelli as CFO. Now it's worth noting that this duo held roles at ServiceNow during most of the last decade and took it from a $90 million revenue business to a successful IPO and then generating over $1.5 billion annually in revenue. So these two are a bit of a dream team with a track record to prove it. And I won't get into the rest of it here, but if you want, have a look at the S1 and you will see the full management team that's behind this business. And their experience and their credentials combined together is really quite impressive. I really am impressed with the team behind this business that's ultimately leading to such great growth and innovation. Okay, so now let's take a look at the financials. Okay guys, so this is a spreadsheet that I put together. What you'll see here on the left hand side is the actual numbers that I've taken from the S1 filing. Over here on the right hand side then is my forecasts, my projected numbers. Down below here then I have some graphs with the revenue, gross margins, and I also have my forecast numbers in there as well. And I've also had an attempt at valuing this business as well based on my forecast numbers. So let me take you through this. If we look at revenue, okay, so we can see that the company is growing massively. That's clear from this visual. In terms of percentages though, they've managed to grow at 155% year over year in Q3 2019, 139% in Q4. In Q1 this year it was 149%, and then in Q2 at 121%. So these are staggering growth rates. And to put some numbers against it, in all of 2019, they generated $264 million in total revenues. Now, in just the first 2 quarters of 2020, they generated $241 million. So they're on track to nearly double their revenues in 2020. So now let's take a look at their gross margins to see how much of that revenue they actually get to keep. You can see here their gross margin from Q3 2018 was 52%. Then we go to 44%, 45%, and since then they managed to increase it all the way up to 62%. In Q2 of this year. Now, in comparison to other software as a service providers, these margins are actually slightly lower than the industry average, which is in the region of 70 to 80%. Now, the reason for this, I suspect, is the fact that Snowflake operates on top of the public cloud providers, which, as I mentioned earlier, are Amazon, Google, and Microsoft. And of course, they pay out some of their revenues to these companies in order to do that. And that's why I expect their gross margins are not as high as other software as a service providers. But if we look at it in terms of gross profit, essentially in all of 2019, they produced gross profits of $148 million. And then in the first 2 quarters of this year, they produced gross profits also of 148 million. So relatively stable margins, but growing revenues. Now let's take a look at their operating expenses to see how much of that gross profit actually goes to the bottom line. Well, if we look at their total operating expenses as a percentage of their revenue, we can see that they are spending a huge amount of money on their operations. And those expenses come in the form of sales and marketing, research and development, and finally general and administrative. And in this graph here, you can see that I've trended the sales and marketing expenditures here as a percentage of revenue, and then the research and development and the general and administrative. On top here then, I have a combination of all three. And if we look at their total operating expense as a percentage of revenue, we can see that in Q3, they spent 188% of their revenue. In Q4, that increased to 239%, and in Q1 of 2019, it increased further to 244%. Now, this is a massive number. To imagine that you're spending nearly 2.5 times your revenue just on operational expenditures is absolutely massive. But the good news story here is that since then, they've managed to bring it down all the way to 120% in Q2 of this year. Now, while these figures are astounding, you can't really argue with the performance of the business. They've managed to generate massive revenues and increase customer acquisition. And of course, it costs money to do this in the form of sales and marketing. But ultimately, all these operational expenses do lead to a net loss for the business. And if we total 2019's losses, we can see that in total they lost 348 million. And for the first half of this year, they've lost 171 million. So if we extrapolate that out, we can say that they're probably going to lose the same amount of money this year as they lost last year. But they are doubling their revenues, which indicates a future path to profitability. So that's the key numbers on the income statement. But what about the balance sheet? Well, in total, Snowflake has about 880 million in cash equivalents and investments on its balance sheet. And they've got total current liabilities of about 673 million. And they have no debt. Now, in my mind, this isn't the healthiest balance sheet for a company that's currently losing so much money. When you're losing over 300 million in a year, you'd probably want to have a higher ratio of assets to liabilities. But what I will say here is the IPO is going to fix all of this, generating an additional 2.24 billion on their balance sheet. But one watch out here is that potentially they could look to dilute shareholders further in order to sustain that future growth. So now let's take a look at my forecasts to see where this company will be in 2 years and where I think the valuation will be. So you can see here I've projected out future revenue growth rates, ultimately leading to a total revenue in 2022 of 951 million. Now, in order to get to these figures, I've projected out their growth rates from Q3 of this year all the way to Q1 of 2023. And I have their growth rates going from 121% year over year in this quarter to 103% next quarter, and declining all the way down to 45% in Q1 of 2023. Now look, these are just my numbers and I could be off on this, but I do expect their growth rates to significantly decline over the next 2 years, considering that they're just so high at the moment. In my opinion, it's unsustainable. But that being said, my projection of 45% in Q1 of 2023 is still a staggering number by any accounts. And that's still a business that is growing at a whopping rate. So from here then, I forecasted out their gross margins. And I forecasted them growing from 62% this quarter all the way up to 68% in Q1 of 2023. Now again, this is just my number. I'd be hopeful that over the next 2 years the company can increase its gross margins as they make their platform more cost effective, negotiate better deals with cloud service providers, leverage their network effect and their economies of scale. And on top of this then, I projected their operational expenditures. The biggest driver here is the decline I perceive in their sales and marketing expenditures, which I have dropping all the way from 70% as a percentage of revenue in Q2 of this year, all the way down to 22% in Q1 of 2023. Now, while this drop looks significant, the actual number of dollars they're spending on sales and marketing does not decrease. What does increase though is their revenue. So as a percentage of their total revenue, the number comes down significantly. I've also projected a decrease in R&D and general and administrative as a percentage of revenue. And overall, this brings their total operating expenses down from 120% this quarter all the way down to 46% of total revenue in Q1 of 2023. And ultimately, in my view, this leads to a path to profitability in Q1 of 2022. And total net income in 2022 of 163 million. Now these are just my rough cut numbers, and there's a huge amount of variables here that could change. The biggest two, of course, are revenue growth and operational expenditures, whereas I perceive gross margins to be relatively stable. A lot of it comes down to how much the company wants to spend on sales and marketing to continuously drive their growth over the next number of years. Can that growth come organically through customer word of mouth and through increasing revenues from customers, or are they going to have to spend even more money to try and get customer acquisitions? These are the types of things that we can only guess. Now, in terms of a 2022 valuation, I've taken my projected total revenues of 1.4 billion and I've given them a valuation revenue multiple of 20, which leads me to a valuation of 28.6 billion. Now, why did I pick a revenue multiple of 20? Well, honestly, it's just down to my preference here when it comes to valuing this company. With some of the valuations we have today, some people could argue that that could be a revenue multiple of 30. But I like to be a little bit more conservative here, and I think 30 is too high of a valuation multiple, just based on my analysis. And the other way you can look at valuing this business is taking future projected net income and multiplying that by a P ratio. And what I've done is I've taken the 2022 projected net income of 163 million and I multiplied that by a P ratio of 100. Now, I've given it a P ratio of 100 because to me this is justified considering the growth rates that I'm anticipating in Q1 of 2023, which are still in the region of 45%. But this still leads me to a valuation of just 16 billion. Now, these are both two different ways of valuing a growing business, and it's very much back of the fag box calculations. Whether you want to choose the revenue multiple or the future P multiple is completely up to you. However, one other way of doing this is to simply take these two valuation methods, get an average, and if we do this, we get roughly 22.4 billion. Which is actually roughly in line with what the company is going to IPO at. But bear in mind, this is a valuation based on forecasts, and it's not a valuation based on the numbers we have this year. In order to achieve this valuation, the company does have some growing to do. However, based on the management team, based on its track record, and based on the potential opportunity lying ahead of this business, I don't think it's a crazy valuation all the same. Now guys, if you're interested in investing in this company and you want to run your own numbers, feel free to reach out to me and I'll send you this Excel sheet so you can play around with it yourself. Just email me at heffernanbros@gmail.com, which I'll link down below in the description. Now, all I'd ask in return, if you want my numbers and if you want the Excel sheet, just give the video a like, make sure you subscribe to the channel and drop a comment down below as well. And even if you don't want the Excel sheet, please do it anyway because I'd really appreciate the support. Okay, so I think I've rambled enough now and I'm going to end this video soon. But before I do, I just wanted to give you my opinion on this and whether I'll be buying or not. And my answer to that is no, I will not be buying this IPO. And the reason is because I don't chase stock prices. I expect that this will IPO somewhere in the median range of $80. And just because of the current investing environment that we're in and because of all the hype around this company, I expect that it could be driven up in value quite quickly. And there's no way I'm going to chase that. Instead, I'm going to sit this one out and see what happens over the next 6 months, next year. This is a fantastic company and it is a fantastic opportunity. And if that valuation came down to sub 20 billions, I would definitely start to consider buying in at that stage. But look, you have to put a ceiling on things. If you're willing to buy in at 22.5 billion, okay, well, what about 25 billion? What about 27 billion? What about 30 billion? You have to put a ceiling on yourself somewhere. And for me, based on my valuations, my ceiling is around 20 billion. And that's also based on the fact that I perceive other opportunities out there with a better ratio of risk to reward. Because if you want to invest in this company, run the numbers yourself, see what you think. It's definitely not a bad investment. They're a savage company, they're going to continue growing, they have huge opportunity ahead of them, and they're in a fantastic sector. This could be a great one to put away and hold for the long term. And if the price does drop then, perhaps you can buy more and reduce your average cost price. So guys, that's it for me. Listen, thanks so much for watching. I hope you got value from the video. If you did, please show me some support. Give the video a like, consider subscribing, drop me a comment down below, let me know what you think of the video and whether you're going to be investing in this company or not. With all that being said, I appreciate every single one of you. Thank you so much, and I'll see you all in the next video. And also, I'm really sorry about the blazing sun I have coming in here on my right hand side. I'm in the process of getting a proper space set up that I can record YouTube videos with proper sound and proper lighting, but I'm just not there yet. So please bear with me in the meantime until I can get that sorted. Thanks again and see you in the next one.